By the time King Louis XIV died in 1715, his legacy of endless wars and palaces left France in financial collapse. The nation was drowning in a debt so vast it was physically impossible to repay with the current treasury. The new regent faced an immediate crisis. The country was economically suffocating, and the government was desperate for any bailout that could stabilize the currency and prevent a total imperial shutdown. John Law was a Scottish playboy, a mathematical genius, and a professional gambler. He arrived in Paris with a proposal that promised to solve the debt crisis through a radical reimagining of what money actually was. Law was also a fugitive. Years earlier, he had fled London after murdering a man in a high-stakes duel over a woman. He escaped from Newgate Prison and spent the following decade wandering through Europe, using his grasp of probability to win at cards while quietly studying the banking structures of different nations. Law understood the psychology of risk better than any government official. He recognized that a broke empire is the ultimate mark for a man with a convincing enough bluff. Law proposed that the scarcity of gold was the primary bottleneck for the French economy. He argued that the government should establish a central bank to issue paper notes, which would circulate more easily and stimulate trade. This introduced quantitative easing. By printing money out of thin air, the government could pay its massive debt without funding new gold. This strategy of printing money to stabilize a drowning market directly foreshadows the Federal Reserve's actions during the 2008 financial crisis. The regent was captivated by the idea. He authorized the plan and appointed Law to manage the national treasury, granting a convicted murderer total control over the French economy. France had effectively abandoned traditional accounting. They staked the survival of the empire on the high-stakes economic theory devised by a man who made his living at the gambling card table. Printed paper only functions as currency if the public chooses to collectively believe it has value. To manufacture that belief, Law needed a narrative that suggested his bank was backed by immense future wealth. He took control of the Mississippi Company, holding a monopoly on the territory of Louisiana to anchor his paper money. He pumped the stock with rumors, claiming the land was a paradise, literally overflowing with silver and gold. In reality, Louisiana was a dense, mosquito-infested swamp. It was a difficult, unproductive environment, holding none of the treasures Law described. This mass delusion was an early version of the late 1990s dot-com bubble. In both cases, investors poured billions into assets that produced no actual revenue, betting entirely on the optimism of a manufactured future. Law successfully rebranded a miserable swamp into the most coveted asset in the world, using nothing but public relations and the desperate need for a miracle. Law then allowed investors to purchase shares of the Mississippi Company using the very paper money his own bank was printing, creating a closed loop of artificial value. He simplified the process of buying on margin. An investor could control a massive block of shares with only a tiny down payment, letting debt cover the rest of the cost. This mirrors the 1920s stock market boom, where millions of people used extreme leverage to buy into a market that was rising on nothing but its own momentum. The frenzy was total. People from all over Europe flooded into Paris to get their hands on shares, driving the price of the Mississippi Company to impossible heights. This period saw such a concentration of sudden wealth that Law coined the term millionaire to describe the people who were getting rich on paper. The French economy had become a fragile structure of leverage. It was now entirely dependent on Law's ability to keep the printers running and the public from looking too closely at the vault. The breaking point arrived in 1720. Large investors noticed that despite the skyrocketing stock price, the Mississippi Company had failed to return any actual gold from the Louisiana Territory. They began cashing out, bringing wheelbarrows of paper money to Law's bank and demanding they be traded for physical gold coins. This chart reveals the mathematical trap Law had built. He had printed exponentially more paper money than the bank had in actual gold reserves. There was simply no way to fulfill the demand. When the public realized the bank was empty, a terrifying panic broke out. Crowds surged against locked doors, screaming for their savings, only to realize their paper wealth had no floor. Every financial bubble eventually hits this wall. The moment the math stops working, the psychological belief that sustains the system vanishes instantly. The Mississippi Company stock entered a vertical plunge toward zero. Within months, the fortunes of the most powerful people in Europe were completely erased. The aftermath was devastating. The French economy collapsed, the paper currency became worthless for trade, and the empire was plunged into a period of deep poverty and social unrest. John Law was forced to flee France in the middle of the night, disguised in women's clothing, to escape the mobs that wanted to kill him for destroying the nation's wealth. Law's story is a reminder that modern money has no intrinsic value. Its power is derived entirely from our shared agreement to trust the story being told by those in charge. Whether it is a 1700s swamp or a complex modern mortgage derivative, billions of dollars will vanish the second the world stops believing in the illusion.